welcome to today's quick or not so quick video seeking to explain what has been happening in the markets over the last 30 days and what lies ahead. The title is Why is S&P 500 surging? So let's get right into the subject. Remember that the daily analysis forms the basis, so make sure that you are subscribed and getting emails into your mailbox. That's as free as my Twitter feed or Telegram, so make good use of all these for timely notifications and extensive talk to myself. So let's move into stocks and let's recap the big picture, at least briefly. You know that an extensive article awaits. It will be still published, so make sure to read more about the reasoning than I'm giving you right now in this video. What I had been talking over the last couple of weeks, the broadening market breadth, is continuing, and the inflation figures, no matter how close to expectations or slightly beating them they had come, that broadening market breadth is to continue, and fresh sectors apart from tech and apart from rotations inside of tech are going to benefit. You remember as well that I had been talking quite positively lately about industrials, materials and energy. As soon as it became apparent that crude oil is not really willing to dive into high 60s again, and that right after 71 level was holding. This is not yet the end of the run in commodities, very far from it, as would become apparent from what I would tell you next. For now, let's add as well financials, which have been quite often part of my daily bullish conditions that I've talked about. These are all going to do well, and we can remember those banking earnings to close the week, what kind of good for risk sentiment they had done. As for sectors that are kind of waiting in the wings, let's see how internally within discretionaries the leadership, the sectoral leadership broadens, and the same goes for staples. Why are staples not doing that well right now? Because of inflation. It's because of, correctly said, disinflation. It's being counted on the consumer having more money for discretionary spending because wages are rising faster than inflation. So that's boding quite well for retail sales in general. But as I foresee the return of inflation, and it would not be only the deal of rising oil prices further on, especially as we go into autumn, and I'm not looking for them to retreat really during winter either. Consumer staples would be catching breath as less and less discretionary spending remains, as the greatly expansionary fiscal policy effect is being not exactly continued with the same momentum, because it's still very far from presidential elections. So the time for consumer staples would only come. Said that the internal rotations would go on, and the valuations of AI stocks, be it from the hardware semiconductor part or beneficiaries such as Microsoft and Apple, would be somewhat checked. Anyway, this is becoming a market of not just top 7 stocks, and the fact that we saw no follow-through selling following the disinflationary data spike on Wednesday, and that those Thursday PPI figures basically enabled the same momentum continuation, that speaks volumes about how much of a downside during any consolidation to expect, and the bearish expectations have to be really dialed back, because this market, no matter what the Fed is saying, doing, is not acting as if it were in doubt. So the rally that we had seen over the last 2 days, that was kind of dialed back on more Whaler reaffirming Friday that after July there would be still 2 more hikes to come. The markets are not discounting them yet see that it didn't force practically any downside. So this is still acting bullish. So we have the following constellation: disinflationary data and bets on Fed pivot, July being one and done, the final one and done. Those solid job market figures still in the coincident sense of this indicator, that would be keeping consumer spending well up, at least in nominal terms. The discussed banking earnings that helped in risk taking, and after relatively flat expectations for Q3 earnings, the markets are expecting really a bonanza over 7% earnings growth for Q4. Seems a bit too much, and especially if inflation picks up, we would be facing the return of the restrictive Fed, the return of the markets acknowledging that the Fed is still going to be restrictive, that this tightening cycle isn't yet over. So that's a big question mark, whether it is September or whether it's going to be only in November. The Fed policy, as to its effect, kind of balancing out still expansionary fiscal policy, that's the catalyst that could dial back the, in my view, overly optimistic Q4 earnings expectations. But that still does not influence those 4 sectoral peaks that I'm talking on the second line. After the March banking crisis that practically subsided, then we are not seeing that much selling. Forget about Friday, that is likely to turn out to be a one-off event over the weeks to come, because I just don't see a starkly universally risk of event happening that would send this market down over the course of July. Let's talk about Jackson Hole and other subjects next, but it's too early for that, and the immediate prospect is not for stocks to go pronouncedly down. And the final point is that the markets have decided to discount the upcoming recession as non-existent. They have decided that the worst is already over, be it for banking, be it for manufacturing, kind of that the recession is hitting different sectors at different times, and we are seeing as well intermittent recoveries sectorally. That's, in my view, how these stock sectors right now operate, and that helps to explain the very, very strong risk on move across real assets as well. When gold surged, silver surged, oil surged, copper is not lagging badly behind, but it will still catch up. There is no reason to be bearish copper either. And if you look at the charts, practically the only one who took significant hit on Friday were cryptos. So that's what we have. So as to recap this week, and here we go with the daily chart of S&P 500 that clearly shows that neither the volume nor the daily candle can be considered as a reversal one for the 500 strong index. Markets are simply expecting the good disinflationary figures to last, and they are acting optimistic and willing to disregard the Fed being still tight position. However, as said, when inflation returns in autumn, see in my article a late day reversal worry that features what I see as the headline CPI progression till the end of the year, what this is going to bring for a risk-taking sentiment. This as well lines up with what I had told you about seeing no immediate risk of horizon on the no risk of event on the immediate horizon. It's not likely to materialize over the nearest weeks, really. So, in case of a shallow correction, the buyers can look for a strong bid to emerge in the 4460s, not just only 4460 but 4460s in futures, and the 4432 level in futures is unlikely to be reached over the next week or simply in one go. There is frankly no catalyst right now. The market reaction is too optimistic and willing to steamroll unless we see hawkish central banks around the world outdoing themselves, and really strong language from Powell when it comes to July FOMC. So we are likely to consolidate rather in time than in price. That's what I'm looking for in the weeks ahead. So it will be still a trader's market within a generally sideways to probably even bullish price move. And why do I say that so hesitantly, acknowledgingly? Because of the market breadth. See how little hit it took on Friday. That's another corroborating piece of evidence. The same goes that tech was almost neutral, and the big sector taking a solid hit Friday was just communications. Disregard the energy downswing over 2%. That would recover. That's a consequence of strong Fed language. Unless we see the no recession storyline being derailed in market perception, it makes a serious downswing really unlikely, as this week had proven. So let's go. That's about the upcoming week. When it comes to data, we have Empire State Manufacturing on Monday and retail sales on Tuesday as the key events, and neither of them are going to send stocks crashing, which was what I told you about CPI or PPI. We though didn't get any kind of daily dialing back or even tapering of the upswing, which was what would have been really constructive. And it's the fact that markets had been running since Wednesday practically non-stop, apart from the discussed waiver pronouncements. That makes it likely to expect no serious downside right next. That's the way it is, simply. So, I'm sure you are familiar with my daily analysis, which are pretty fast and quick to read. That you follow me on Twitter and on Telegram. Remember that the site terms apply. Beware of impersonators, and that's right about it. Obligatory disclaimer, and have a nice rest of the weekend.